Hello, Warriors. How you doing, David? Welcome back, Ryan.
Morning, mate.
How are you, buddy? Michael
All good.
Weissman. How are you, Richard? Ingmar? The dollar's down. Remember, McDonald's had a commercial about the dollar's down and what you could buy for $1. Waiting for commercials like that to start hitting the tape. Since Blake's maid is asking about the dollar, one of our guests, Angie, Goddess of Grains, as a group, and says all these farmers want to know what they should do about the dollar. So there's a lot of fear right now, a lot of stories of de-dollarization. As we approach what could end up being a support zone, I don't like the RSI reading on it. I have to see some more evidence. What are you thinking? You came back fresh, Ryan? You need a couple days to get the feel of being back in the saddle again. I'll leave you alone.
Yeah, I need a couple of days to get used to the cold weather again.
Yeah.
I'll be getting some sun, but it's nice.
Why don't you put it? Let everyone see what you look like with a suntan. Turn on your webcam. Come on, let's see. What you accomplished on your first vacation since 2018. And you know what? You probably think you have the record for the longest amount of time since you've had a real vacation. And you don't. You don't, man. I'm just letting you know you don't. Anyway, so I'll move over to Kman. There he is. There's the beach boy. So were there any good waves on the beach? I can't hear you now. All right. Okay, so Ryan, technical difficulties. Let me go to Kman.
Heidi, hi. Good morning, Dale.
Heidi ho.
How's it going?
Pretty good. How about you?
Yeah, I'm doing all right. Doing all right. Thanks.
Look, Ryan's got really kind of a sunburn.
Yeah, I'm actually trying to see if his hair has grown back a little bit over holiday.
Oh, no more hair jokes.
Okay.
No.
I can make hair jokes. I don't have any either. So.
All right, well then show yours, and I'll put my shades on.
No, don't finish that sentence.
I'll put my shades on so the glare isn't too bad.
Let's talk about markets. That's why we're here for. Okay?
All right, well, go ahead.
I don't know about you. I'm here for the hair talk.
All right, well, because you have so much. Steve donates hair every month to cancer patients that go through chemo.
No, that's actually not true.
You should do that.
I've lost a little bit, although it doesn't show much yet. My wife, though, oh my God, and my son has inherited that. You can't imagine how thick hair they have.
Oh yeah.
They indeed have enough to donate to half a planet.
Yeah. Well, you'll be paying for those haircuts for a while. Anyway, Steve, you want to take it? Kman, you want to take it? The dollar's down here. I know Blake has this line here.
Yeah.
You showed it yesterday.
Yeah. So it seems like, well, for one, the market has been trading more the headline than the core CPI, and probably I've seen a lot of stuff like betting on that the core will start to catch up, etc. But it's still a story of, or it was at least until a couple of hours ago, a story also of euro strength. It seems like with the strength of the European indices and also the differentials, the interest rate differentials coming off, the euro has really benefited from it. Yeah, I think it's a bit of everything, and also now coming to think about it as well, the S&P, sorry, may not be a stranger, because if they are selling foreign currencies, they also have their own diversification program. So if they sell euro Swiss, they probably buy back a little bit of euro dollar as well. But and that may have helped euro process too. But I'm not sure whether it's going to completely, whether it's really going to continue. I don't see, and the yield sphere, the interest rate sphere also hasn't really traded the headline on the CPI. So I'm a bit cautious for running really short dollars here. I was long euro dollar. I took them off late in the morning, and just trying to see whether there are more legs into this move or not. Of course, if the euro dollar keeps the break, then we may be on our way to 112. But it's the jury is open on my side at least.
Hey, Kman, and good morning, guys.
Morning.
Just to add to this conversation, obviously the weak data that we got yesterday is weighing on the dollar as a whole. But you have producer prices today, which obviously is expected to be weak. And then we got retail sales, which I think is going to be really maybe the data that could actually put the nail in the coffin for the dollar, because it's I was talking about this on the trade-off last night on the Pepperstone show, is that we have it's hard to bet against the American consumer, and always has been, and in my experience. But we are probably at a tipping point with the consumer, because this is inflation that we've never really witnessed if you've been in the markets for the last, Kman, you might have remembered, some of the tail end of the inflationary pressures that we saw, way back in the day. Mm-hmm. But for most people, and most consumers, you can just put it at that, we haven't experienced this type of inflation ever. So we are probably getting close to, if not already at the tipping point, from a consumer standpoint. So if we really see some weakness in the in retail sales, that could, like I said, that could put the nail in the coffin for the dollar going into the end of the week. What are your thoughts there?
Yeah, absolutely. I think everybody expects this PPI to come off. Perhaps it's going to confirm what's going on, but I still prefer to be a little on the cautious side for it right now. I've got other stuff on, but the consumer and the jobs market, to me, that's going to be the two clinchers if the dollar's really going to come off a lot more, because CPI, PPI is probably going to be a global phenomenon when it comes off, and consumers and job markets may start to diverge a little bit, especially considering that over the historical period, the US economy as a whole is more dynamic than, for instance, the European one. The old continent is usually a bit slower to turn around than the US one. So as you say, that if the consumer starts to falter, then the dollar will likely get another knock on the head.
Yeah, to be honest, it is to be expected, right? And why is that? Because what has been the biggest change that we've had, right? Other than inflation, it was the byproduct of inflation, increased rates. And we know that, unfortunately, in the Western world, but even more so in the US, the consumer is spending a lot based on credits. So the credit becoming a lot more expensive, of course, will end up, weighing on the consumer. And we've already said, and I've said that 100 times, we need to remember that retail sales, for example, are not adjusted for inflation. So if somebody actually adjusts retail sales that we've been seeing for a year for inflation, we will realize that actually the consumer might have kept spending, but they're getting less for what they're spending.
Okay. Just looking for, here's still the banks, the regionals. They don't look so good. They look like they're, there's another low in them.
I think Warren Buffett was saying yesterday that he expects more banks to fail, which I agree with that. But he also said, which unfortunately I agree with that as well, that nobody's going to lose their money. Now, it's not because I'm a mean person that I'm sorry about the statement that nobody's going to lose their money. It's just another
Bailout.
proof exactly that there is no capitalism anymore. Everybody gets bailed out. Unfortunately, what people don't realize,
consumer.
Unfortunately, what people don't realize is who pays the bill for the bailouts.
The consumer who doesn't get bailed out.
Not only that, the consumer that in essence is burdened with the inflation that we create to bail out everybody, right?
Yeah. I just wanted to show this chart so that Blake could take a look at what the market thinks about the strength of the consumer. So here's a consumer discretionary, peaked in Feb. Looks like a failing rally to me. That doesn't look like it's not reflected in stock shares, consumer strength. Looks like it peaked in February. We're in April.
Yeah, we were having a talk. I don't know if I wasn't sure if I was muted or not. We were having a conversation yesterday on the Morning Edge about just inflation and just I mean, people globally, how they're just feeling the heat and whatever the number is of Americans that live paycheck to paycheck. I mean, they've got to be feeling it at this point. And so that discretionary spending is the first thing to go. And, and we're just marching towards the inevitable, in my opinion, where we're going to see consumer spending really just come to a screeching halt. Now, the question will be, and this is really the question, and I want to, we had a question from Lucas, and he said, and I'm not sure if any of you guys addressed it. He said, "What can we make? What can we make of this euro? What can happen, to have this euro lose strength?" And the answer to that question is, I'm not too sure. Except, if we ever
risk off.
I was going to say the only way the dollar really is going to firm up here, and it would be, if it was across the board, it's definitely going to be against other currencies. More so than the euro, like, the Aussie and the Kiwi and, things like that, perhaps, would be some risk aversion. And we will get to a point where bad data is not good for stocks. It's like yesterday we did see an issue, and I'm wanting to hear like some other guy of you guys' response about the CPI and the weakness of the CPI. I figured should have allowed the market to catch a bid, and it didn't. And that is scary when data that should be supportive of equities was not. And
I think the Fed minutes drew it back.
But the CPI, to that point, Dale, the market was already rolling over ahead of that. So I agree with you. The meeting minutes just kind of held the market down, but the market wasn't getting ahead of itself, following the CPI. It didn't, move. It moved higher initially, and then it just sold off, for the next few hours as we waited for the minutes. So I don't know. I don't know. Like I said, when good data is bad for the markets, or what should be supportive of the markets don't care about, that's scary. And so if we start to see equity markets roll over, I think that's really the only way at this point that the dollar is going to firm up, unless we get some really hawkish talk from central bankers. But as you guys have probably seen, the comments that we've seen from the Fed have not been that. So anyway, I'll take a step back and see if there's any other.
Why don't you grab the charts?
Well, all right. Well, let's talk. Well, let's talk to Stelio. So what do you think, and Stel? What do you guys discuss over there on the Flow show with Ryan and Kman?
I wasn't there this morning, actually.
You weren't?
There.
Oh,
I was back. He's out the door, Blake.
I don't even want to talk to Stelios then.
I was on a
Ryan,
playground.
I really wanted to just talk to Ryan the whole time, but
I was on a playground with my girls.
I know you weren't here, so what did you want to tell everybody?
So, the euro, I think it's driven mostly by central bank divergence. So the ECB members are still, just now, actually, we had more comments from, who was it? Nagel. No, actually not Nagel. Sorry. Who was it? Anyway, yes. Yes. So basically, still a lot more to be done. And, it's fit 25 or a 50. I mean, it's still the divergence of central banks. And yes, the ECB was late to the hiking party. So they're probably going to be late to stop it, to stop. But so the euros has strengthened. Remember what I was saying for the past couple of weeks? I think the euro dollar is going to hit 110. Well, here we are. We passed it a little bit. There's another high now that we need to get to, which was the was it end of January? I can't remember. Yeah, there you go. You have it on the chart. But the euro is still strong, and as long as there is this divergence, I think that will remain. Now the question is what happens with the dollar, because everybody now is bearish dollar, and your cleaner and Steve's barista probably wants to be selling the dollar. So I think the market's gone one way, and so if you've had a trade, the K and we took out some of our silver longs yesterday, basically here 25.60. I took a third off. I think K took a quarter off. I think it's prudent to be taking some profits if you have been in the money, because I think we might be close to a little leg higher in the dollar. I don't think the dollar is going to go anywhere near previous highs, but I think a nice little pullback lower in the euro dollar and in the dollar itself, a little grind higher, I think is long overdue. So and regarding equities, I still think the path of least resistance was the upside, and yes, after yesterday's CPI, we saw a little bit of a rally. Then we came right back, and the minutes didn't help. But we're not selling off. That's what worries me. If I was short, we're still here. 4,100 in the S&P. We should have been lower. So I think we see 4,200 first before we go lower. So nothing has changed in my short-term view. And in my medium-term view, I think equities will have to correct at some point, but not just yet.
You know what I think?
Pretty actionable.
Yeah, for sure. You know what I think?
What?
I think, Steve, are you here?
Of course I'm here.
Steve's visit to the United States was right here, which probably marked the low of the euro when you had the least amount of buying power. Great timing, Steve.
Of course. Isn't that always the case, mate?
Yeah, it is. Yeah. So if you guys don't know this, Steve, him and his family came and stayed at our house for like 10 days and took them through the Southwestern America tour. America to Grand Canyon and
Las Vegas,
and all the fun stuff. Anyway, yeah, that was the low. I think, Steve, you marked the low on the euro. But what are your thoughts here as we go into PPI and retail sales this week, or the remainder of the week? What are your thoughts here?
Having to do with retail sales, I do believe that retail sales underneath have already shown months of weakness because, as I said, they're not adjusted for inflation. I do think that the consumer is really squeezed. We've seen savings be at multi-year lows, and that tells you all you need to know. Now, having to do with the PPI, we know that the PPI is a leading indicator of inflation. So, a softer PPI will point to softening CPI in the months ahead, which is likely, right? And we get something like that, will obviously put further pressure to the dollar, because currently, for the first time after so many months on being wrong-footed, the markets are actually getting some proof that their theory that they traded prematurely, that the Fed is going to pivot, has merit, right?
Are you looking for a right? Right.
Or
Or you're waiting for a response? Yes. Okay.
No. I'm done. That's what I have to say.
Okay. Well, Steve, we'll see. We'll see how the market responds to PPI and retail sales. I really do think that the dollar is vulnerable here. I mean, you look at the
Absolutely.
dollar. Wouldn't it be classic FX price action you see, I wanted to give you a lot, like guys, like a longer term view of the dollar. Okay, so this is the dollar long-term channel we're following. By the way, everybody's talking about the death of the dollar, and when it gets to that fever pitch, you got to be a little careful, right? So you got the dollar index that is slumping towards, obviously the 2023 lows. It is under pressure, but what you might not notice is the bottom. If you take the bottom of the channel to the highs, this 618 retracement is not too far away. Like, wouldn't it be classic dollar? Just think about this going into the remainder of the week, because I like to position myself, over the course of the next couple of days of what I think is going to happen in like the days or the weeks ahead. Like you get this sell off, right? And just imagine today, tomorrow, dollar comes under pressure, which is more than likely, right? Weak PPI numbers, it continues to show some disinflationary pressures coming through. Retail sales numbers missed the mark. Everybody's like, oh, crap, the American consumer's done. Let's short the dollar. The dollar breaks through support at 100.80. We slice through the 100 mark, which is going to be a big figure issue anyway. And then we hit the monthly or the weekly 618 retracement around 99.20. And, think about all of this just
Very
going
viable.
into the, I'm sorry?
Very viable.
Yeah. I mean, as we go through all this situation, we start breaking lower, right? And then as you start breaking lower, everybody gets mega bearish to the dollar. And then next week is kind of a week that we don't have a whole lot of data coming out, but then you have at the end of next week, we have producer prices out of the Eurozone, a lot of, or not producer price, I'm sorry, PMIs, a lot of, growth data that's coming out of the Eurozone and out of Europe and out of the UK, actually, I believe at the end of the week as well. If that data starts to come in weak, then you're going to get people that get the second thought about how strong the euro and the cable is. But I really think that the euro and cable, can possibly break out here. I mean, you got the euro that's pushing up against highs. You got the cable that looks like we want to, make a move for 126. I mean, does anybody disagree with that narrative right now? What, Kman, you have any thoughts here, Ryan?
That's what I said. That's what I said on the Flow Show. That's what I said for several days on the Flow Show. Actually, I think cable has a fair chance to go to 126 or 127.
Yeah, what's interesting about the cable is, man, we've been. I mean, it's this is where. I'm glad I don't have a surplus of laptops sitting around for me to throw, and thank goodness I just haven't been trading the cable that much, because it had its way with me last week. When we broke out here, but notice we had this breakout. Then you got a lot of people long. Of course, everybody got long, and everybody got stopped out. Then you got people re-entering on the short side, and then you got people that are like, oh crap, I need to get out of my longs. Of course, they get stopped out. We go the other direction, and then here we are. I mean, it's been I'm
typical markets.
I'm just watching it from afar this week, and I'm looking at it going, oh my God, thank God I'm not trading that right now. But yeah, I mean, it looks constructive, right? It looks like we could break out, but the euro is what really is a standout. And I want to take you to a couple other dollar pairs really quick. You got the dollar Swiss. That I mean, look at the Swissy, just absolutely breaking down right now, just getting clobbered. And when the Swiss franc, garners strength like this, you've got to be kind of, a little perky as far as what the hell's going on. You got the dollar Canadian that continues to break down in a bear flag pattern. Even the Aussie has recovered from not breaking down or trying to break down, but is recovered because of this just dollar weakness all over the place. So anyway, we've got a lot of dollar weakness coming through the market. I want to also really quick, since we still have a few minutes, Ryan, you've been gone for I don't know 10 days, 4 weeks, 13 months. How long have you been gone?
Never long enough.
Never long enough. Okay, so being away, in your view, what's changed, and what do you notice that's different from when you left to when you're back here? I mean, anything that like stands out, you go, oh my God, I can't believe silver's breaking out or whatever. What are your just
Yeah,
off the cuff.
I'm not
thoughts
surprised.
here.
I'm in the dollar bear camp. I'm not surprised to see the dollar weaker. I think dollar yen is interesting because it's playing two forces. It's playing the new Bank of Japan man Ueda, who is as of now coming out with the same lines as the old fella. So in this, we've got a bit of a two-way push and pull. You've got the weaker data coming in. The market changing its expectations for the Fed, like Steve was saying, the pivoters finally getting a bit of merit. And I think on the Bank of Japan side, we could see some further upside in dollar yen. I started shorts on Monday, too early as I usually do. I'm short from about 132 and I'm short some more 133.70s. I'm happy to build a short position if we go higher. But I think the data isn't going to hold up anymore. And even if the jobs market is still strong as it has been and the good NFP we saw last week, I don't think that can carry everything else if the data starts to turn sour. And I think that the dollar's in for some trouble. He's had a great big rally when rates were going up. And this is the flip side of the coin. And the market's going to jump on board. And every opportunity it gets, it's gonna sell that buck unless something changes.
Yeah, I'm kind of feeling the same way. Dale, what are your thoughts here with the dollar? When I laid out kind of what I'm thinking with the dollar, you have any comments to add to that, or what are your thoughts here? Dale may have ran to the restroom before.
I'm here.
Oh, okay. Sometimes that happens, Dale. You're like, yeah, I got an interview. I gotta take off for a few minutes.
Yeah.
But what are your thoughts here?
About what?
The dollar. I was just asking.
Well, I really like your scenario, and big round number, how they like to go for BROs. So I think par will get attacked, and then I'd be looking for some divergences to fade that decline.
Yeah, theoretically, if you look at like the daily sentiment index, or as you like to call it, I'm sorry, not the DSI, the RSI, as you like to call the real simple indicator, right? Which I love. I love your term there. But like you look at the daily RSI, if we actually do break down, which it looks like we're going to, right? The dollar index looks vulnerable. So if it does, will we make a new low on the RSI? Will we just come back down and retest these lows and, give us some sort of divergence? It's entirely possible. So, it's going to be interesting. And we're about 2.5 minutes away from PPI. Any last minute thoughts from you guys before we cover this data?
My view is that we're going to continue on the same trend. So I think we're going to slightly disappoint to the downside, even though we are expecting PPI year on year to drop from 4.6% to 3%. Again, this is all mathematics, right? From the big jump this time last year, the rate of change has to drop, all else being unchanged. So let's keep an eye on that. I think we might surprise a little bit to the downside.
All right. Well, we'll see if we will or not. And let me go ahead and make some adjustments here. So let me pull up I got the 10-year over to the right. I got the S&P right in the middle. Okay. You'll see the S&P. Here's yields, right? Over to the left, since it's PPI, we'll just put up the dollar index, but we're going to put it on a 15-minute chart. Yeah, there you go. There's going to be the dollar, and then I'm going to bring in the data flash, which comes with your ForexAnalytix subscription. You'll see all the data populate right here. While we got about a minute, I just want to say, if you guys haven't tried out ForexAnalytix, make sure you do so, because not only do you get this really cool app or the platform, you also get a mobile app. So you get notifications when support and resistance levels are breached, when new analysis has been updated. You get tools like the live squawk feed that comes through right here. You also get the calendar, and where we have the data flash, which gives you that instant news when it's released, which we'll be watching here in just a second. And you get all this analysis from Grega, Andre, Elliott Waves, harmonic, macro analysis from Stelios, a lot of analysis on the platform. Then you get inside of our chat room, which is obviously one of the best and most active trading communities out there. So, and really that's the heartbeat of ForexAnalytix is the community. So anyway, come check it out. It's $1 for 10 days. Let's go into the news. PPI coming in. Wow. Really weak.
Month on month is weak.
Look at the dollar getting clobbered.
Softer on the year, 2.7% versus 3%.
Well, there you go.
Yeah.
Core
Somebody
came in as expected, 3.4%.
Look at the dollar just getting clobbered, pushing down towards lows.
That should be expected, of course.
The Fed has to be worried now a little bit, I think.
Yeah. The euro is trying to break out, and the dollar just continues to weaken. I mean, this is what you would expect. Now, here's the question, and I know, Dale, you have an interview coming up. So, this is
a great one.
Oh, you're bringing in that Maldonado person?
Yeah, we're going
I
to
love Ben.
Hear about the epoch cycle.
I cannot wait to hear Ben. Ben's probably one of my favorites that you bring on. But really quick, I just want to say this. We're really flirting with that time in a market cycle. And obviously we're bringing on Ben, who's going to talk all about cycles. But we're in that cycle right now, or close to it, where bad news doesn't necessarily translate into good news for equities. And I think that is something that when the market starts to figure out, hey, wait, the Fed's going to keep rates high no matter what. It doesn't matter what the data is until CPI gets down to 2%, period, end of story. That's when the market really starts to, falter on this type of news. But we are seeing deflationary data. That's good. That should be supportive of weaker dollar. And retail sales tomorrow are going to be uber important. So make sure you all are here tomorrow, as we will cover that at the end of the week. Dale, I'm going to turn it over to you, but I want to thank the entire ForexAnalytix team. Kman, Ryan, great to have you back. Stelios, they missed you on the Flow Show, I'm sure. Steve, it's always great to have Scuba Steve here. And Dale, thanks for always being the best host. Make sure you guys check out the Trader Funding Program if you want to learn how to trade our money and not risk your own money. Watch that little 2-minute video right there. All right. Cheers, guys.
Thanks, team.
Cheers, all.
Great to have you back, Ryan.
Thanks, mate.
In fact, I hear K-Man's considering doing some karaoke on the Flow Show. So you may want to have a talk with him about that. Okay. All right. Anyway, Ben Maldonado.
Hey, Dale.
One of my favorite guests talking. How many years have we been talking now, Ben?
It's probably over 3 now, almost 4,
yeah.
I think.
Yeah. Okay. So, been following the epoch cycle with you during that whole time frame, and we get together every 3 or 4 months, and a great call on gold. Last time you were here, you said you have to be long gold. We've been talking about the dollar, and I'm not sure if you prepared anything today, but I also know that you think both gold and the dollar are the place to be, rather than a weak dollar just taking gold up. You still think that way about
yes
that there will be a turn in the dollar? Okay, so do you want to share your screen or just
yeah let me get the screen here for you.
Oh, see, and he always comes prepared, and with the epoch cycles. So okay, I'm going to let you fly.
Yeah, no, it's great to be here, Dale. Yeah, last time we sort of did what we were looking for the year, and of the 5 or 6 markets we covered, I think we said you got to own gold, you got to own silver. I actually said Bitcoin, which is unusual for me, and the reason why we said those 3 was really the effects of the epic cycle, right?
Oh, I thought you had said that to wait on Bitcoin. You thought it was going to get a lot cheaper.
I did think it was going to get cheaper, but I said you got to have it on your radar, because remember, the epic cycle is all about losing confidence in the current system,
right?
And so you look for off ramps of the system, right? And what people will look at. So let's go through
Robert Kennedy Jr. came out and made that statement.
Did he really?
Yeah, he came out. He's an anti-vaxxer, and I think he wants to run, and he's really against CBDC. and he said people are going to Bitcoin as an off ramp. He called it like it was. So that's what we found out after SVB, is that it really had to move based on, a financial crisis. Anything outside the banking system, right? Gold is outside, Bitcoin's
Silver.
outside. Yeah, silver. Okay, so you're still bullish, or you think we'll still have a liquidation break in Bitcoin if we get a final washout in S&Ps?
Yes. And let's go through. I mean, basically my methodology is I start with the cycles, I then look at technicals, and then see if we can layer in fundamentals. And when you get all three of those things lining up, that's when you get these mega moves in different markets. So it all starts with the cycles. In this presentation, we'll go over the major cycles that are guiding us right now and affecting us. The epic cycle, as Dale described, this connection with the 70s, with the inflation and stagflation of that period. The thing I want to talk about, I'm going to spend most of the show on, is the war cycle that we're in, and it's has dramatic implications for the dollar. And so I think it was really timely that you guys were talking about the dollar a lot on the F.A.C.E show this morning, because I'm gonna address a reason why the scenario that you guys laid out looks very probable. And then we'll hit the highlighted markets that sort of align with the cycles, and look at the technicals and say, what can we expect? Remember, I always have to warn people about cycles. It's not like a cycle hits and you see the exact effect immediately, right? These are big cycles, so it's over time. But what you're trying to do is have the wind at your back instead of in your face when you're trading.
I've had quite a few of those in the face.
Yeah, it's not fun.
It's
much easier and much more enjoyable to swim with the current than against it.
Yeah, well, I'm Bob Seger fan, and he wrote Against the Wind.
There you go.
Great song. Go ahead.
Yep. So the epic cycle, we're nearing the end of a 400-year cycle that has governed how we organize our societies and how we organize essentially the world and the globe. I call this is the real Great Reset. The one sponsored by WEF and all these other crazies is not the Great Reset. The Great Reset is things are changing because a 400-year cycle is coming to an end, and the next 400-year cycle is starting. The main thing about the epic cycle, and people are seeing it, more and more people are seeing it every day, is the things that we used to depend on, not even think about because they were so reliable, are no longer reliable. And that realization is happening in more and more people. And as that happens, this is when people look for off ramps and alternative things, because you can't depend on those institutions, those services, those things that we have counted on and taken for granted for decades and decades. It's getting more intense, and the evidence of failure is going to ramp up. So that's something to continue to watch in your daily life.
Okay.
The ones I highlighted this time, and again, a caveat for everybody: I'm not a political animal. Anything I say has nothing to do with politics. I'm strictly looking at economics and markets. So take your political battle somewhere else. I'm not interested in that. So the ones I highlighted this time: transportation, the slew of train derailments we had, very disturbing, right? I don't know about you, Dale, but I don't ever remember this many train derailments happening in this short a period of time. And again, it's just another sign of a failing institution, this time the transportation and the infrastructure that we have. The French and Israeli government protests, I think those are perfect expressions of the epic cycle effect. The governments are saying they're going to do something, and the French, they're breaking a promise they made. People are rioting and saying, no, that's not okay. We're not happy with that. In Israel, it was trying to change, I believe, it was a battle between the executive branch and the courts in terms of a power struggle. But again, it's an example of that. Global banking system. Silicon Valley Bank, Credit Suisse, a couple examples of, again, things we used to say, well, they should be fairly solid. We're confident that the regulators have everything under control. That's not there anymore. I mean, everybody's, Dale, in your daily talks with everybody and all the people you interact with, who would be concerned about every regional bank? I mean, has that ever happened in your career?
No, I mean, the closest analogy would be the S&L crisis. I think it was in the 90s.
Right, late 80s, early 90s.
Yeah, where they had to, bail out all the S&Ls.
Right.
So that's the closest analogy I could come to small banks and what's happening with regionals. But no, people weren't worried about regionals going into this at all.
No. And it's, I mean, you're hearing people talking about, well, there's only 4 banks that you should really be comfortable with, right? The big 4: Citibank, Chase, Bank of America, Wells Fargo. Never heard that in my whole career.
Yeah.
But that's what we're hearing now. And then the last one is the justice system. More and more we're seeing that it's politicized and it's not about justice anymore. And I think that's a big one, from the Supreme Court, recent decisions in the Supreme Court, to the indictments and everything that's going on with the former president. It is just not a good sign for people's confidence in the justice system.
They've had leaks before
never
had leaks before on the abortion issue was leaked.
Exactly.
So,
it's just and you can
everything.
see, right, when you step back and look at it, it's not an all at once erosion in confidence. It's just this sort of
Stealthy.
drip. Yeah, it's this drip, drip, drip effect that the net effect is people don't have confidence in the system and are losing confidence in the system. So let's talk about the 70s cycle. We've compared the current period to the period from the 70s. The parallels are there. We had Nixon, whose counterpart was Trump, and you can see all the different items there that have been matching up when those two were president. So that's a pretty much a done deal that happened. And now we're looking at Biden and Carter, and everything is starting to gel here. The ones that I highlighted recently are things that I think are important and are coming to the fore right now. In the 70s, Nixon took us off the gold standard so that the dollar was no longer redeemable for gold. And now everybody's talking about, as you guys correctly pointed out, the death of the dollar. It's no longer going to be the reserve currency. Other countries are looking at trading in different currencies and want to replace it as a reserve currency. I'll refer you. Did you see Top Gun Maverick?
Yeah, I did.
Okay,
Yeah.
There's a great line in that movie where the general or the admiral was telling him about he's going to be replaced and drones are going to take over and pilots are done. He goes, that era is over. And he looked at the guy and he said, "You may be right, sir, but not today." And I think with the dollar, it's the same thing. Eventually, they're going to be right that it is going to be replaced and it is going to die, and all these sort of Pollyanna statements we're hearing now will come true, but it's not today, and it's not next year, and it's not in 3 years, and it's not in 5 years. It's probably more like a 10-year thing. So that has really big implications for the dollar and what the dollar can do in the next couple of years. The other one that we wanted to highlight is Fed policy mistakes. Policy mistakes were made in the 70s by the Fed, which caused inflation to go higher and last longer. And it looks like history is repeating. We shall see, how resolute Powell and the Fed can be in fighting inflation and hold off easing or stop raising rates. But the amount of pressure that's already on them, I just can't see them not making a policy mistake in the near future. So we'll see how that goes. These are the themes that I highlighted with Dale on our last talk in January. The one I want to focus in on is war, which we said there'll be an escalation and expansion. And the reason why I want to focus in on this is there are some incredible connections with cycles that we have to discuss and then study what happened in the time periods before and give us an idea of what's likely to happen today. And based on that, how can we position ourselves to benefit from it? So the war cycle, we are in a period where war is more likely. I've done a lot of work on this in the last 3 months, and came up with this this connection with the current period to major wars and conflicts that have involved most of the globe and certainly the United States. What it points to is on the horizon. I don't know if it's next week, next month, next year, but in the near future, we're almost guaranteed, because the probabilities are so high, that there is going to be some sort of global conflict. One of the things with war that you have to look at is you have to look at where is the location of the conflict, because that affects what happens to capital. It affects what happens to assets, and therefore it affects asset prices. So we're going to look at potential locations. We're going to look at the economic effects of war. What's most likely to happen based on what's happened in the past. And then, of course, in every crisis, there are major opportunities. So we're going to look at the markets where we could position ourselves to potentially benefit should this come to pass. Major conflicts that are tied to today, to the present cycle we are experiencing. Number one is the American Revolution. That was a long time ago, but a major global change occurred because of it. The interesting thing I've highlighted in each one of these wars is a very important point for investment and interest rates and currencies. U.S. government debt went from 75 million to 130 million during the American Revolution. We piled on tons of debt because
Luke Roman agrees with you. The worst asset to own in wartime is a treasury bond.
There you go. There you go. American Civil War is the next one that was tied to this cycle. Government debt went from 65 million to 2.6 billion. And of course, World War II, one of the major wars in history, is also tied to this cycle. Government debt, the U.S. government debt went from 50 billion to 258 billion. Wars are expensive to fight. They must be financed, and they are generally financed with issuing debt and printing money.
Buy war bonds.
There you go. So here, my question, and this is a rhetorical question: where will the debt go if we do actually get World War III? We're currently at 28 trillion. So where's it going to go? Here's a graphic. I don't know. I mean, it could be. I mean, here's a graphic I think that is both enlightening and shocking. What's happened to the debt over the last 30 years? We're sitting at 28 trillion, and World War III hasn't really started. Maybe it's the proxy part has started, but the participation hasn't really started. So again, a lot of debt. What does that mean? We're going to get to the economic effects shortly. In real estate, it's location, location, location. War location when you're talking about conflict is extremely important, because where the war is fought determines who benefits and who suffers. There's the destruction of capital where the war is actually prosecuted, versus the safe havens where capital and money goes to protect itself from the ravages of the war. Potential hotspots around the globe right now are the Korean Peninsula, Eastern Europe, South China Sea, South Asia, and the Middle East. That's not any, classified intelligence there. You just read the news and look around the world, and you can see those are hotspots. The important thing.
What's that? One. Bud Light.
That's pretty amazing, isn't it? Holy moly.
Anyway, I don't know.
The marketing people never thought that would happen.
Anyway, go ahead.
So
sorry.
If a conflict does break out, right? Remember, with cycles and with the markets, there's never 100% certainty. We're always dealing in probabilities. The reason we have high probabilities is you saw 3 different major wars line up with this cycle today. So good chance we're going to get into a conflict. The first thing you want to look at is, where's the conflict taking place, and is it spreading? Where is the kinetic activity occurring?
Yeah.
And that's super important because of what we're going to talk about in terms of the effects, economic effects. There are, believe it or not, there are both positive and negative effects of war, economic effects. The negative, some are pretty obvious, some may not be. Inflation. Wars mean inflation. You're destroying things, you're building things, and you're destroying things, and then you're building things, and you're destroying things, and you have to finance all that. And it's usually done by issuing debt and printing money. There's the destruction of capital. Where the war is prosecuted, you have infrastructure being destroyed, bridges, roads, you have farms, you have factories, you have cities. Location matters. Places where there isn't that destruction, capital goes there. One of the universal things that happens is trade disruption. The people that you traded with, you could be fighting with now, so you're not going to be trading with them. And your trade partners or your war allies that you've traded with, those trade routes get disrupted by your enemies. So trade gets disrupted. So having manufacturing ability, being able to feed yourself, being able to provide your own energy needs, those are all major advantages when you're in a war. And the last one, which we've talked about, is these massive government debts. Those are the negatives. On the positive side, you get a short-term boost to growth. You gotta arm and supply your military. You gotta crank up production, so you do get a short-term boost to growth. This is one that not a lot of people think about, but is really important. Is major technological advantages and advancements come out of wars because of the investment in military technology, which then gets transferred over to the private sector. Just a couple examples of things that have come through military and war sort of spending: radar, GPS, jet engines, nuclear power, computers. An entire industry, the aerospace industry, came out of the military. The internet. Remember, the internet started as a DARPA communications network. In case of nuclear Armageddon, they needed a way to communicate with all the different pieces of the military and the government, and they created DARPA, which then became the internet. So that's a positive that will come out of it, and we'll talk about that in terms of the opportunities. And the last positive is the winners of the war get to shape sort of economic institutions and policies and how trade goes. So these are really important if you're thinking about investing and looking at taking advantage of this. These are very important effects that you got to take into account. This is a declarative statement that is completely true and unassailable. War is inflationary. Here are many examples you can look at. Let's just cite the ones that we're connected to. Civil War, you had annual inflation of over 20%. World War II, annual inflation of over 7%. Post-World War II, over 10%. So we can be pretty well sure if a conflict starts, given that we're in the cycle of the 70s, and given that we have this war cycle connected here, we are going to continue to see inflation. Inflation is not going anywhere. The chances of it going somewhere and ending soon are very, very small. So you got to make sure your investments and your philosophy and the way you're putting money to work takes into account inflation. So as you said, bonds, not a great place to be. This is an interesting chart I shared before and it was one that I wanted to show on this presentation again, because let's look at the periods we're talking about. This is Revolutionary War. Huge spike in commodities, right? Here's your Civil War. Huge spike in commodities. Next war, if we get the World War, probabilities are we're going to have a huge spike in commodities and the cost of these different stock that we want to buy. So we got to be aware of that. So commodities needs to be a part of what we're doing. So what are the opportunities? If we're looking at a major conflict breaking out, there are opportunities in safe havens, and we're going to go over some of the safe havens where capital will flow. The obvious one is capital is going to flow away from the kinetic activity area where the war is actually taking place, and it's going to flow to places where there is relative safety or the perception of safety. And we'll show you some of the markets that we can use to take care of that.
If we go nuclear, there is no place.
Absolutely right. You're absolutely right.
I mean, you know, so I mean, it's hard to believe that there's going to be a World War III without nuclear weapons, that people are going to restrain themselves, especially if they're losing conventional war.
Yeah, it's one of those
Isn't
things. Yeah, I agree with you, Dale. I mean, it's if someone's backed into a corner, are they going to use nukes? I mean, when you make the decision they make, whoever makes the decision to use nukes is basically
already made them probably.
If they're making a decision to end the world.
Yeah.
And that's what's possible. There's no question about it.
Yeah, that's a big stop loss, man. All right, go
well,
ahead.
it's the ultimate put, right? There's no worries after that.
So you're short everything, you make a fortune, and
the world's
worthless. Yeah. That'd
be just our luck, right?
Yeah. Anyway,
the preppers would really be bummed. But anyway, so we'll talk about the potential safe havens. Given Dale's caveat, we have to say, short of a nuclear war, here's what you do.
Right.
Commodities. The commodities we want to look at in studying history. Energy has done very, very well in times of war. Agriculture done very, very well in times of war. So we're going to look at a couple charts from energy and a couple charts from the ags. Defense aerospace companies. In every single conflict, the military, defense contractors, arms suppliers, anybody who's supplying anything to the military has done very, very well. On that sort of one of the positives, what new technologies or what new industries could come from this? Let's spend a few minutes on this because I don't have any specific charts or anything to look at because this is going to be evolving. But these are some of the sort of broad areas that I've identified that I think you want to be looking at for making investments depending on, how things come out of this conflict. Artificial intelligence, we're already seeing that, begin to make inroads and get into the public consciousness. So I'm sure if it's used in the military, it's going to come out as with practical applications in the private sector. Space, we saw some of that bubble happen, with the zero interest rates, but things are crashing down. Orbit just filed for bankruptcy, but certainly the aerospace industry and space travel and space exploration is going to be one of these things that comes out of this. Genetics, studying DNA, developing treatments, therapies, in addition to weapons, which they're probably doing now for attacking specific DNA. But the advances in genetics should be fantastic coming out of this conflict and this cycle. And remember, we're talking about like in 2028, 2030, not, again, this is not next week, next month, but these are things to have on your radar. Alternative energy, not just for green reasons, which are good enough, but for the reasons of, if they knock out your power grid or they knock out your refineries, how are you going to power your military? So I'm sure alternative energy is going to be something that comes out of this. And these last two are two things that have always made quantum leaps after these major conflicts. It's transportation and communication. I have no idea what the new products are going to be or what the new systems are, but you can always look in those two areas for advances based on technologies and solutions that the military use that then get commercial application. Anything else you'd add in there, Dale? I know you think to the future as well.
I have no idea what, that maybe won't be a phone but everything is, voice recognition, and you just, have a Siri that does everything for you.
Yeah, that would certainly be in communication. So
Yeah,
I would agree. It's going to be interesting to see.
I have a bid on George Jetson's car.
Man, that would be nice if we could do that, huh?
Yeah. So,
every kid wanted one of those.
Yeah. So those are my two guesses.
Okay, nice. Let's look at some of the charts. So my view on the dollar is going way, way higher. I do agree with you and Blake and the other people in your group. I think we'll probably get a washout. Maybe we come down, do a little false break, take out this previous low, and then we rock it. Because remember,
you're looking for new highs. Like you're looking for one.
Wait. I'm sorry. Hey, Dale, I hate to interrupt. I just had to step away. I'm going to have to step away for a moment. I just want to say, Ben, I love having you here, and I'm sure you're about ready to get into it, but I'd love to hear what your reasoning is for the dollar.
Okay, overall. So here's the main reason why.
Okay.
Right now, in any times of crisis, money flows to the dollar. Right? If we do have World War III, and it's not prosecuted in the continental United States, but it's prosecuted in China or in the Middle East or in Eastern Europe or these other hotspots that I mentioned, capital is going to leave those places, and it's going to come here. It's going to come into the dollar. And so not only do I think the dollar, if this World War III thing comes about and it doesn't go nuclear, it stays conventional, and it's not prosecuted here in the States, capital's coming here for the only reason, not that they think the dollar is great or that the US government policies are great. It's for safety.
Yeah. So it's not, we're not involved in the mainland.
Yeah. It's not on our ground.
Right.
Hey,
so
Dale,
things aren't getting destroyed here. Right.
Yeah. And I didn't want to I wanted to interrupt, and I apologize for interrupting, but I have to say that, that Ben, this is a similar situation we were at, not because of war, but because of the financial crisis, the GFC, if you will.
Mm-hmm.
People were really moving away from the dollar at that point. And, when the crap hits the fan, people like find out that they it's like they're out in the ocean and the tide goes out and they're like, oh, we just found out who's not wearing pants, right?
That's
they didn't
exactly
have enough dollar
right.
exposure. Anyway, I'm going to continue to listen in. I just wanted to hear your comments there. All right.
Sure. So this is the theory, right? Is if there's no kinetic activity in the continental United States, and there is a major conflict in the world involving most of the world, money will come for the safe place, which is that right now. Will it be in a
CDBC, a Fed digital coin, or digital dollars?
I don't know, Dale. I honestly don't know. That I'm really up in the air about that
too. They're starting a now system in July, I believe. That's a payment, and people are saying that enables the the conversion to a digital dollar.
Right.
So I don't know how to explain it to people either.
The only thing I would say is the central bank digital currency is not in harmony with the epoch cycle, because it's sponsored by a centralized old power structure.
That's why they're doing it, to try and hold on to it. So they may try it and it fails.
I think that's the most likely thing, is they'll try it and it'll fail.
That's a very interesting point. Yeah.
So
it's just because it doesn't rhyme with the cycle.
No, it's going against the cycle.
Yeah. So maybe it happens after the epoch cycle ends, which you say is like 2030, right?
Yeah, 2027 to 2030. Yeah, right in there.
All right.
So we'll see. So the dollar, I think, is one of the first safe havens. It goes against the current narrative, which I like, which is, the dollar's dead. They're going to be replaced and all this other stuff. But I do think that Blake and you are right. First, we got to get a washout. You know how currencies do. They got to trip the stops before they go. So I can see that
They got to
100%
take out
happening.
that par 55 low
Yeah.
on the Dixie. They'll go for it. Yeah.
And then, but watch when the activity, when the kinetic, if it happens, again, there's nothing's for sure, but if it happens, watch where it's happening, and then watch the flows of money right away. It's going to come. If it comes to the dollar, then we're on track and everything's moving the way we thought. So that's the first thing, the dollar. Gold, I think, is something else. This is the obvious one, right? In times of panic and trouble, people go to the gold. And here, Dale, is where you get that, what I referred to, which was dollar and the gold going up at the same time.
Okay.
Because people may say, I don't want to move into the dollar, I want to buy gold. Okay. So some people buy gold, some people buy dollar, but I think both are going to be safe havens.
Okay.
Silver, another safe haven.
Yeah.
Money's going to flow into silver for the same reason it's going into gold and the same reason it's going into the dollar.
Been
for
really
safety.
A hell of a move from 1980 to where we are now.
Yeah, I mean, you can see with this
we're
this
right at major
thick red line. We're
here.
coming into resistance, but if we clear that and sit on top of it, man,
where is that? 26?
It's around 27, 26.
Okay.
In that area.
Yeah.
But yeah, so a pause here would not be, out of the question. But I still really like silver and gold.
Okay.
I think Bitcoin could become
the bottom's in then, Ben. We're not going to have a washout. If S&Ps go to 3,200, Bitcoin's going to resist it.
Maybe we get a higher low. I don't know. We have to watch and see.
Okay.
Could be, maybe they do another false breakdown here or something.
This is a major for me, a switch for me, because I think you were pretty bearish. You thought
I was. I didn't like it. Hated it all the way down.
You shifted after SVB, after what it did at that big move.
That was the shift for me, but mentally I shifted before I talked to you in January, because I was like, it's a perfect asset for the epic cycle, right?
And it's really portable. There's nothing else that you could just memorize some codes and travel anywhere in the world to where there's no conflict and have access to your wealth.
It does appear to be a place where money's going to run. Here's one that I don't think we were expecting, but
I'm hoping there's a break to 14 grand.
That would be nice. The Dow.
Yeah.
Let's say we get into a major conflict and people want to own stocks. They're going to own the biggest, most stable, most financially secure companies in the world.
Okay. And
that would be the Dow. I mean, right now you can see on a monthly, we're just triangulating like right under resistance. So, I'm not saying Dow's going to new highs next week or next month. Again, everything we're prefacing on this war cycle is if the kinetic activity breaks out, this is where capital could flow, and capital that needs to be in equities or wants to be in equities is going to probably go into the Dow. Biggest and most stable companies in the world. So that's the Dow. Let's look at energy, crude. I think we've seen the low. I mean, look at that spike down right into support. It's perfect right here.
Yeah, that really was.
I think we've seen the low in crude. Unless, the U.S. strikes some deal with Venezuela to bring them online and flood the market with crude, which is possible. This thing looks like it's going much, much higher. I mean, I think, 150, 160 is doable in crude. Here's the only chart that we talked about in January that hasn't done positively since we talked about it. But what I would say on natural gas is look at all these lows, right? Going back into the 90s. Look at all of them.
Yeah.
They're all in this area.
Yeah.
So when the Widowmaker turns, it's going to turn. And if there is, a global conflict,
do you wait for her to remarry and then it's safe to do it? Because then she has someone else to kill.
Yeah, that's true. She had someone else to focus on.
Just curious, buddy.
So I still like nat gas. I think we're in the area of a low. You gotta use the smaller time frames, the shorter time frames, to figure out when we finally get the turn. But bigger picture, I like it.
Okay.
One of the ags I wanted to highlight is beans. I know,
Yeah.
Dale, you love beans. I think we got beans going to the 20s.
Yeah, I do too.
I think we're going to see beans in the 20s. Every single major conflict that's connected to now, the Civil War and the Revolutionary War and World War II, all three of them, there were issues with food.
Okay. Can I
Because
ask
trade
you
routes get destroyed and farms get destroyed.
I just saw an article about a monster El Nino coming in 23 and 24. I mean, a big El Nino,
Really?
which has a predisposition for drought in the breadbasket of the U.S. So, you know, that could
be major.
a catalyst for that.
Yep.
Where's that red line, vertical line come in? This is a monthly, so what
It looks like it's about May.
May of this year?
Yeah. Yeah. That's a timing
Okay,
spot.
because I know a guy who's an ad guy is looking for June lows in the grains.
Yeah. May, June. Yeah.
Yeah.
Yep.
So, okay.
Yep.
All right. Like
so that's the one grain. Corn looks good too. Wheat's a little less bullish, but I'm just showing you beans.
Okay.
Cotton.
Okay.
Let me show you something with cotton. See this little triangle we're doing here, right here?
Yeah. Yeah.
Look at this formation we did before the last blast off.
Right. Yeah.
We're forming another triangle. Again, cotton is something that the textile industry did well every single time there was a major war. And I don't know if it's uniforms for the military or what it had to do with, but textiles did well. And I think technically cotton is setting up, you know, we've had this correction, big correction off, but look at the move it made when Russia invaded.
Yeah.
Look at that move.
Yeah.
So wherever the war is, if there's any kind of cotton production that's at risk, man, cotton flies. So we'll watch cotton.
All right.
Here's one that, you know, I usually don't follow individual stocks very closely, but this is an ETF for the S&P aerospace and defense industry. Yeah. You know, it's got the big guys in there: Lockheed Martin, General Dynamics, Raytheon, Boeing, plus some smaller guys too. If we go into a major conflict, you gotta have exposure here. If you need equity exposure, you gotta have exposure here, because there will be trillions of dollars spent on armaments, and systems to prosecute the war.
Okay.
And then with the innovative stocks, as I said, we talked about, you know, the industries. It's a matter of trying to identify companies, trying to identify what technologies are being used by the military, and then are they going to get applied to the private sector once the war is done. And that'll become, you know, you start seeing the heroes of the war, like I guess the Iraq War, it was the Patriot missiles, right? Remember how everyone was crazy about those? So it's stuff like that we got to keep our eye on to see if we can find the next emerging technologies that are going to get mass adoption. We do, if you like the content and the information, every week we do a little recording. You can go subscribe and listen to these recordings. They're all free, no cost, and we just put our thoughts on tape and put it out there every week.
Views are going up, buddy.
Yeah, it's interesting. People are liking it. And then if you need to reach me or follow me, you can do me here. I have it locked just to keep out all the idiots, but if you request a follow, no problem, I'll let you in.
Okay, and you also took off the retweet.
Which one?
On your Twitter, I can't retweet. That middle button doesn't work.
Oh, maybe because it's locked. I'll have to see about unlocking
anyway,
it.
It's not, people can't retweet your stuff right now the way it's set up. I'm just
okay.
You know.
Yeah.
Okay.
There's always a downside, right? You get rid of the idiots and then you can't retweet.
Yeah, and because you know I've look at it and that the retweet button is disabled. So
okay.
You know how much I like to retweet your stuff. So
absolutely.
Anyway, Ben, another great presentation. Really appreciated. Follow this guy. You know, I maybe you didn't like it, but you're like the Frank Sinatra of technical analysis. You're like the godfather of the epoch cycle to me.
I'm glad it's helpful. I mean, really, it's the idea is to just, and I'm not trying to scare anybody, but if you're aware and you have an idea of what potentially is coming, you won't be the deer in the headlights when it happens, right? If it actually happens, you'll have an idea.
You'll be the guy driving the car with the deer in the truck that is going to be your next meal instead of you being the deer.
That's exactly right. It's to be prepared so that either you get in front of it, or when it happens, you can act, and instead of react, you can act in a proactive way to protect yourself and your families and your finances. And that's the idea.
Well, thanks for being a watchman for us and introducing us to the cycle, Ben. And
glad to help.
Giving people a great framework and narrative to walk forward into the uncertainty. Appreciate it, bro.
No problem, man. I always enjoy coming on with you and Blake and everybody. I appreciate the content that you guys provide, because it's the same thing. You're warning people, you're preparing them, you're trying to help them out, and I think that's a noble cause.
My trading warrior brother, Ben Maldonado. Follow him on Twitter at Ben Maldonado. And I'll get in touch with you, Ben, and we'll talk this summer.
Sounds great, Dale.
Okay, bro.
Yep.
So that's a wrap, everyone. You could join the team on the Morning Edge 1 minute ago. Okay. Not in 5 minutes, not in 2 minutes, but 1 minute ago they started. Okay. Have a great day. Don't just count your cycles, count your blessings. See everyone tomorrow. Thanks again, Ben.